This is Oswald and his girlfriend Esmeralda. In 2 years they want to get married, but their finances aren't exactly in order yet. They need to get themselves organised so that they can live comfortably in a new home. Currently, Oswald works for McDonald's as a manager and earns $1,600 pre-tax weekly or $1,210 post-tax weekly, while Esmeralda works as a hospitality courier and earns around $1,400 pre-tax weekly or $1,079 post-tax weekly. As well as these incomes, the couple shares a deposit of $50,000 in the bank. The current living situations dictate certain budgets. As it stands, Oswald's expenses include $100 a week on fuel, $120 a week on a car loan, and $100 a week on board and lodging for living in his parents' house, while Esmeralda's expenses look similar, with $100 a week on fuel, $180 a week on a car loan, and $100 a week on boarding and lodging for living in her parents' house. Taking these expenses into account, it can be understood that the total budget for a genuine month for a couple would look as follows, with the cash balance indicating their monthly savings, assuming they don't require other expenses to go about their daily lives. This budget shows that with the current expenditure, the couple spends only 22% of their total income each month. Using this combined monthly savings, the CommBank Home Loan Calculator suggests that up to $826,200 can be borrowed with principal and interest home loan monthly repayments of $4,547 on a 5.22% standard variable home loan over 30 years. Principal and interest repayments simply mean that you pay for what you have borrowed or the principal, with additional repayments to pay for the lender charges or interest. This repayment method is preferred over just interest as the repayments are simply less, while standard variable is the description given to a bank's long-term fixed rate. However, due to the fragility of the sources of income and the high risk of loaning out such a high amount of money, it is recommended that the couple borrow only $500,000 for their home loan, which readjusts their monthly repayments on the same home loan to $2,752 a month over 30 years, putting them in a much more financially stable position, considering that they will be self-funding more in the future. Considering that they will be repaying their home loan in accordance with a budget, it is recommended that the $50,000 deposit be used for their wedding, with the remaining money being reinvested elsewhere. When making a budget, it is important to understand the expenses well, including the home loan repayments. Over the first 5 years, the monthly repayments would be as follows on the given rate of 5.22%. Using these repayments, our budget for the first month of repayments of the couple living in their new home would look as follows. Notice a savings of $728.75 as compared to their savings when they lived with their parents of $1,789. This denotes their different financial position. However, if the budget is managed well enough, then the couple will not have to worry about going into debt. For argument's sake, the hypothetical situation of a change home loan rate should be discussed. In this example, the increase of 3% will be investigated, meaning a rate of 8.22%. The monthly repayments over the first 5 years are given here. Using simple maths, the difference in the monthly repayments can be observed for the first year, signifying the negative impact that this has on the couple's financial position. By applying the repayment to the previous budget, a major flaw is discovered. When living on the outlined budget, the increase of $1,251.67 in the first month's repayment results in a saving only $415. Therefore, it is highly recommended that Oswald and Esmeralda spend less on their home loan, as the possibility of a change home loan, while minimal, is conceivable. This would put the couple in a financially unstable condition, as the budget does not take into account the possibility that anomalies such as a broken car or robberies may occur when moving in, which would not leave them with any room to move financially. To conclude, Esmeralda and Oswald are able to move into a $450,000 to $500,000 home, given their current incomes and foreseeable expenses. However, their success in paying off their home loan is entirely dependent on the standard variable rate of 5.22%. Committing to a loan with a high percentage would most definitely contribute to a poorer financial position for the couple and inevitable debt. But if everything goes according to plan, their wedding in 2 years will be a great success.